Okay, hello and welcome to our bi-monthly BNZ Agribusiness Economic Update. The year is flying by and there is a heap of volatility out there, so I think this update is very timely. My name is Geoff Rawcliffe and I'm part of the BNZ Agribusiness team based in the Waikato. I have Doug Steele joining me again today, where I'll be asking him a few questions we think will be relevant to update you and your business on. Doug is a Senior Economist with the BNZ, specialising in agribusiness, so he's the man to talk to when you want to know what is going on. This session will take around 20 minutes, so sit back and grab a drink or a snack and enjoy the update. Welcome, Doug.
Thanks, Geoff. Let's get into it.
So we'll have to start with interest rates. A surprise 0.5% lift by the Reserve Bank just a day or two ago. So clearly they are still worried about inflation and low unemployment. Are we at peak yet? So what's going on, Doug?
Yeah, I think we are getting close to a peak, at least we think we are. As you say, there is a lot going on in the interest rate space, both here and offshore. But yeah, that 50-point hike from the Reserve Bank did surprise. The markets were on the day pretty much fully priced for a 25 basis point move. So a 50 did come as a bit of a shock. Although, having said that, in the bigger picture, I think you can sort of see the Reserve Bank essentially just ploughing on with what they had previously said they were going to head up towards a peak of 550 for the cash rate. So they've lifted that 50-point move, takes them to 525. They've just seemed to have front-loaded that 550 peak that they were previously thinking about. So it looks like they're going to do a 50, or have done a 50, and then maybe another 25 at the next meeting in May. That's what we think they will do from here. At the same time, we don't think they're going to be cutting rates anytime soon. We don't see interest rate cuts this year. They are still worried about inflation being too high, the labour market still being tight, even though it might be loosening a little bit. It's still too tight for their comfort, and inflation expectations as well. Just people thinking inflation is still high and acting accordingly, that is worrying them. But they did note all those things as being really important, of if they moderate and how much they moderate, then that will determine the future direction of policy. So, they're not just going to keep going if things start moderating as they think they will. So the current projections from the central bank, I think, is still for a 550 peak with a 25 basis point lift in May to get us there. Interesting that market pricing is pricing a cut by the end of the year. And, as the Reserve Bank lifts the cash rate, the market seems to be getting more keen on pricing in cuts. And as that happens, while the cash rate might not yet have peaked, we do think those shorter term fixed rates probably have peaked now.
Yeah, thanks, Doug. A lot going on there, and this Reserve Bank seems to like to surprise the market every now and again, don't they? Now, touching on the longer end of the curve, I suppose a few people are starting to look out longer where some rates are a bit cheaper than the current floating and short end rates, and wondering at what point in time do you consider going further out? So what's sort of driving this inverted curve at the moment, and where to from here?
Yes, the curve definitely is quite inverted now. So those shorter term rates are higher than the longer term rates. That's essentially reflecting the fact that the market is pricing in cash rate cuts towards the end of this year and into and through next year. Should really say that doesn't necessarily mean it's going to happen. It's just where the market is currently pricing. And even the interest rate market reaction to the Reserve Bank's 50-point hike is quite interesting. The wholesale interest rate curve lifted immediately on the 50-point move. And when I say immediately, it happens within seconds. But then within a day, it's come back down again. Still more inversion, so those longer rates are lower. And I think that's the market saying, if the Reserve Bank does continue to take the cash rate higher now, then the market is just going to build in more cuts later. You could make an argument that's the market saying that the Reserve Bank might be going a bit too far, or just the fact that, yes, we will get on top of inflation at these sorts of levels and interest rate cuts will come down the track. So, there's quite a bit going on there, even domestically, but I think there's also a heck of a lot offshore, and that's having a big influence on our longer term rates for sure. The global banking issues that we've saw in the US with a couple of bank failures and Credit Suisse being taken over or subsumed by UBS, different central banks changing views. So the Bank of Canada and the Bank of Australia, Reserve Bank of Australia, on pause versus the Bank of England, the European Central Bank, and the Fed still lifting rates. There's been an enormous change in the outlook for monetary policy in the States over the last month or so. So right now the market's pricing about half a chance of another 25 basis point lift by the Fed. If you go back a month ago, that was more than 100 points the market thinking the Fed had to do to get on top of inflation. But all these banking issues in the States have saw that completely reprice. That downdraft of those global interest rates into the New Zealand market, I think, has actually been quite pivotal to why the Reserve Bank of New Zealand lifted 50. They saw that downward influence from offshore. It was having the chance of lowering retail rates in New Zealand, and I don't think the Reserve Bank wanted that to happen. So they lifted 50 to try to keep retail rates where they wanted them. So it's certainly worth keeping an eye on what's happening offshore, because that is having an influence on our interest rate curve as well.
Yeah, interesting. There's certainly a lot going on there, isn't there, Doug? And hopefully we don't have to get used to these higher rates for too long. But yeah, we certainly need to see inflation come down a bit yet. Commodity update and offshore markets. So prices have been softening a bit further since we last caught up, Doug. We saw Fonterra lower their forecast for this season, and since then we've seen quite a decent auction drop at the last one. So I'm sure listeners will be keen to hear your updated view on next season's payout. What's your latest thoughts here, Doug, and across the other main agri commodities, both now and looking forward?
Yeah, if there wasn't lots going on interest rate markets, commodities, there's plenty as well. Fonterra did lower their forecast, what is it, 8.30 now for the midpoint. I think it was 20 cents lower than their previous view. And then we saw the GDT auction shortly after drop nearly 5% in one go. That's a fairly big drop on its own, but it actually takes GDT prices now 38% lower than a year ago. That's a hefty retreat from what was very high levels. So things are certainly softer in the dairy space. What's interesting is China seems to be buying, but there is quite a bit of weakness elsewhere on the demand front, while at the same time the Europeans and the States are making a lot more milk. They're much bigger milk markets than we are, and that's having a downward influence on international prices as far as we can tell. So I think, where we're at now, it does set up a relatively weak starting point for the new season. Our current forecast for the 23-24 season, we've put it down to $7.60. I sort of take the point forecast with a grain of salt. There is such a big error bound around any point forecast at this point in proceedings, and we just try to balance the risks of, it could be lower, it could be higher, rather than having a number that seems to be slanted one way or the other. Effectively, $7.60 builds in some improvement in GDT prices towards the latter part of this year and into next year. The idea that global growth is going to be pretty weak this year, that's sort of a known. With any luck, the banking issues globally settle down and we get some improvement in global sentiment that might see dairy prices lift, demand elsewhere outside of China pick up, as well as in China. It is interesting too to know that dairy prices relative to the likes of oil or international grains are quite low. So there is a bit of scope for return to normal, if you like, on those relativities. And that gives us some hope, I guess, that at the moment we're at the low ebb with the strong supply out of EU and US, which we think will slow down a bit into the end of the year. But right now, if you look at current prices and current currency, we think that's actually implying a milk price in the low sevens. So that's to say, if prices and currency stayed where they are now for the entire next season, if that was ever to happen, then we'd be looking at something in the low sevens for milk price. So as I say, big error bounds, that's sort of the lay of the land. the momentum at the moment is clearly downwards, but hopefully when we're into the bulk of next season and then towards the end of this calendar year, there might be some improvement to get us up to 760 and hopefully even more than that in the end. I guess, it's not all negative news out there in commodities by any stretch. You look at the meat markets, they are bouncing quite strongly. We talked a bit about that last time, Geoff, and it seems to have extended. Lamb prices are higher internationally, generally speaking. Chinese demand is a big part of that. The UK and Europe, not as bad as they might have been, so that's been a net positive compared to where we might have been on that side of things. I don't think it's the lift in lamb prices is enough to sort of save the entire season, if you like. Average prices are still going to be down on a year ago, but that underlying picture seems to be improving in the lamb market. We are watching the chance of more product coming out of Australia. That seems to be underway now. But I guess on the flip side, New Zealand's been relatively tight. If you look at the beef and lamb estimates of the lamb crop from last spring, it's down something like 8.7% on the prior season. So, supply out of New Zealand is tight. It's not the best way to get price improvement, but it will be part of the picture. I think in beef, prices are bouncing even more. Quite a strong lift off the bottom now. I think that's a lot to do with the states seeing rain in those previously drought-affected areas and really turning off the supply in the states, coupled with stronger demand in China, that has seen quite an aggressive lift in international beef prices. In China, it's also notable, though, that they have now agreed to let Brazilian beef back in following the foot and mouth disease outbreak there. So that might take some of the steam out in time, and likewise more product out of Australia could do the same. But generally speaking, in beef, prices are looking a lot better than they were. In fact, even this season's average could well match last year's record. The underlying dynamics there are certainly on the improve. I guess we can't not mention the weather and the impact of the cyclone in particular. Our thoughts just to the people that have been really seriously affected by that. The impacts have been very varied, from complete sort of devastation for some to no impact at all for others. We haven't got the luxury of time to go through all the impacts. There are many, but if you just look at the estimates from some industry players, for the likes of apple production, estimated to be down 21%, I think, was the industry estimate. The Hawke's Bay itself down 33-ish. Grape production may be down 20 this year, although that's probably a lot more to do with the massive grape harvest last year than the cyclone impact, although that has had a material impact on a few players in isolated areas. Kiwi fruit down as well, 10% lower on Zespri estimates compared to last year. Again, not all to do with the cyclone, more to do with the spring frost and the wet during spring. And I guess on the kiwi fruit pricing side of things a bit better there, at least the outlook for them. Zespri's forecasts for the season ahead are a lot better than the very weak numbers that we saw for the season prior. So, there's a lot of impacts around the weather. It's billions of dollars impact. And if you just sort of look at even the export scene, we think, including the weather impact and all the other stuff we've been talking about, whether it be volume or price on their primary sector, total exports in 2023, we think will be about 7% lower than 2022. But a lot of variation in the detail there, Geoff.
Yeah, thanks, Doug. Certainly a huge amount going on there and some good positives in there, but a bit tougher on the dairy side. And there'll be certainly be a lot of people looking at next year's budgets and trying to pull costs out where they can, because as we've all talked about before, the cost inflation over the last couple of years has been massive, and as we know, it's often fast to go up and slow to come down. So thanks for your insights there. Exchange rates. So I suppose the key ones up against New Zealand, that 50-point rise might have seen a bit of lift, did it, Doug?
Yeah, it did against the US. I think it lasted all of 7 hours, and then it was back to where it started, which is interesting in itself. And it does show you right at the moment that the influence on the Kiwi currency is a lot more driven by what's happening internationally than necessarily what's happening here at home, including the outlook for or movements in domestic interest rates. They are having some impact, but it's a lot more about what's happening in the international space, including in the US. And our story has been that the US dollar has been overvalued. We think it will soften. The flip side of that is the Kiwi going up. The international banking issues that's come up over the last month or so has sort of delayed that story a little bit. You know, the Kiwi's still mincing around in the low 60s. We still think it will lift later in the year if these global banking jitters can remain calm as they have in the last week or so. That's not a given, but if confidence does return, and it seems to be, so far so good, then that better risk appetite overseas we think will start lifting the commodity currencies like the Kiwi dollar. So maybe into the mid to high 60s by the end of the year. We'll see how we go with that. But more broadly across the other major currencies, we see the Kiwi lower. So it's really a US dollar story with the Kiwi higher against the US. But against the others like the pound or the euro or against the Aussie dollar, we see the Kiwi falling through this year. It's interesting, the Kiwi Aussie actually, because that's where the interest rate effect is having probably a more obvious, because New Zealand and Australia are sort of facing into the same world. If we have a different interest rate outlook, that is affecting the cross rate with Aussie. So the Reserve Bank of Australia has paused their interest rate hikes, currently at 3.6%. We've lifted ours another 50 points to 5.25. And we've seen the Kiwi dollar lift against the Australian on the back of that, I think currently sitting around about 94. But we do think that those higher rates in New Zealand will slow growth quite a bit here. Ultimately, that won't be good for the Kiwi dollar, and we'll see the Kiwi fall against the Australian. It is important for agriculture, even though we don't sell much to Australia because of that third-party competition. If we've got more product coming out of Australia, especially in the meat side of things, and their currency is cheaper than ours, then that might have some competitive issues in particular markets. The only other thing on the currency thing we've mentioned before, and we'll say it again, one day it'll happen, Geoff. We've now got a new bank governor in the Bank of Japan, and there's the prospect at some point that they will change their interest rate curve control policy. And when they do, you could imagine that the Japanese yen will strengthen, and potentially quite a bit. So the Kiwi could well fall against the yen. We're still thinking that will happen sometime. You never quite know when, but if that was to happen, then Kiwi lower against the yen.
Great. Thanks for your insights there, Doug, and certainly interesting to see the difference in the cash rates between Australia and New Zealand, isn't it? Global or local events of note, good way to sort of wrap things out. Anything going on globally or locally that could or is impacting New Zealand, and in particular agriculture, that is worth commenting on?
I need more than 20 minutes, Geoff. No, I mean, there is obviously lots, but I'll just sort of pull out a couple of things that I think is worth thinking about. The weather. The risk of El Nino is sort of getting on the radar now that we've had 3 La Ninas and La Nina is now finished. Obviously that'll have an impact locally if it was to develop and become strong. More rain in the south and west and drier on the east. But I think, probably one thing that might not be thought about too much is what the influence on Australia of an El Nino event. The 3 La Ninas that we've had have brought significant rain to the east coast of Australia, and those rebuilding of the sheep flock and the beef herd over there has been enormous. You look at the Australian sheep flock, it's now getting up to its biggest since 2007. And their beef herd is the biggest, getting up to the biggest it's been since 2014. And just the biology of that over the last 2 or 3 years, there will be more product coming out of Australia anyway, we expect that. But if El Nino was to develop and be a strong one, and you start getting some offloading of that more than normal, then that could have downward influence on those meat prices, give it into next season and beyond perhaps. So that's just worth thinking about. But there's a lot of negatives out there, Geoff, so I've got a couple of positives to finish on. the signs that the extreme tightness in the New Zealand labour market just starting to ease up a bit is useful. I'm not saying that it's easy to find staff. I'm not sure it ever will be in rural New Zealand, but and there's still upward pressure on wages. But there is some signs that the very strong net migration turnaround is having some influence. So that's at least not as difficult as it was. And shipping costs are falling. They have been for some time. In fact, global shipping costs are back to pre-pandemic levels, and we're now starting to see some influence on the New Zealand route. So that's helpful for New Zealand exporters, and even importers to get product into the country. And some cost line, as we mentioned, costs are up, and we know that. But there are some that has turned over, like the likes of fertiliser prices offshore falling, and putting some downward pressure on domestic prices is helpful too. And just lastly, the New Zealand UK free trade agreement, it was signed up to some time ago now, but it's set to come into force pretty soon, maybe in the next couple of months or so. So that would be a positive for the primary sector to get more access into that UK market as well.
Great. So thanks for ending on a couple of positives after some, plenty of interesting things going on out there as always. So I think we'll call it to a close there. Thanks, Doug. Certainly, like I said, lots going on. So thank you again, Doug, for your time and insights into topics of interest. And thank you to everyone that has listened in today. There is, of course, only so much Doug can cover in 20 minutes. So if you're interested in more detail, you can find Doug's latest rural wrap and other market research pieces on our BNZ website. Just search market research. So thanks again for tuning in, and hopefully catch you next time. And last word to Doug, as always.
Thanks, Geoff, and good luck, everybody. Cheers.